Hey guys, Joe Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look at a trade idea that I'm currently monitoring. It is to do with the S&P 500, and it is bearish, unfortunately, for the bulls. Or it's not bearish, to be honest, because I'm not sure what's going to happen with the market right now. We're at a very pivotal moment, technically, for the S&P 500. But what I'm watching out for is a potential breakout to the downside. Of this current sort of mid 3,900 level, which I think, and I'll explain why, but I think could open the door to a retest of last December's lows in the 3,700s. Now, let's talk about what's going on. We've been pulling back in the last couple of weeks as US yields have been rising. Let me just show you the 2-year. It's at its multi-year highs, closing in on 5%. You got the 10-year now above 4%. As markets price in a more aggressive Fed tightening schedule this year, as a result of the string of strong US data reports that we've had out this year, out so far this month, like the strong ISM, the strong jobs, the strong inflation. Just today, actually, let me just bring up the calendar. We've had the latest weekly job numbers out of the US, and you can see here initial claims. 190k better than expected. 190k, that is consistent historically with a very, very strong labour market. I mean, even like 250 is consistent with a strong labour market. So things are still hot in the US. But anyway, all of this has sort of led to this pricing in of this higher for longer theme in the US, which has put some pressure on stocks. Of course, higher interest rate expectations are a negative for stock valuations because of a higher risk-free rate, which basically decreases stock valuations if you look at the discounted cash flow way of valuing stocks, which is pretty much the most popular way of valuing stocks. So that's why we've pulled back. We're currently testing the 200 DMA, the 100 DMA, and the downtrend from 2022, which has been in play for now more than a year. Now, if we were to find support here and over the next couple of days rise back a bit above 4,000, that would actually be a very bullish technical sign that potentially, we're going to get this steady grind higher into the low 4,000s. But I'm thinking, given the fundamental backdrop that we've just been discussing, more likely we're probably going to see a continued pressure. And if we do get a break below this downtrend, below the 200-day moving average, below the 100-day moving average, and I mean like a decent break, say we fall below 3,900, I would then be looking to potentially, say we break here, I would then be potentially looking to short a rally or a short-term recovery and then ride that lower to this 3,700 and, 3,760-ish support area. Because if we are talking about Fed interest rates going above 5.5%, if we are still talking about the US economy being strong at the moment, hence the hawkish Fed, but then weakening to a greater degree later on this year because the more aggressive Fed tightening response and earnings that we had earlier this year were indicative of a coming earnings recession. Then this is a pretty toxic combination for stocks, hence why I think there's a risk that there could be further downside. But listen, I'm not betting on this happening just yet. I want to see a break below these key levels, okay? And just another thing, actually, this is worth noting. Another reason why I'm thinking we're probably headed lower rather than higher is because we recently broke below this uptrend that had been in place since last year's low. Which I think added a bit of bearish momentum. But anyway, that's a trade idea that I'm monitoring. If this key level breaks, then we could be in for some further downside. Hope you all enjoyed the video, guys. Hope you all found it informative, and I will see you all in the next one.